Enjoyed your meal so far. It's my great pleasure to introduce our guest of honor, Stephen Poloz, the Governor of the Bank of Canada. There's a full bio in today's program, which you can read at your leisure, but I thought it was appropriate to make a few introductory comments. Now, we all know that the Governor and all his colleagues at the bank like their statistics and they like their financial guidance, so I thought I'd provide a few directional comments of my own. So this is the second time that the Governor has addressed the Chamber here in London. He kindly addressed the Chamber in March of 2015, and at that time he was a fairly new head of the Bank of Canada, and so the demand for the lunch was trending positive, but within the target range of the Chamber's expectations. So after the lunch, we had an opportunity to look at the data. Eliminating any transitory factors, we discovered that, in fact, the Governor had drawn a larger audience than the previous Chamber Speaker, who happened to be the Prime Minister of Canada. Needless to say that some 3.5 years later, we have an even larger audience here today to hear the Governor's insights into the Canadian economy, the new USMCA, the global economic trends, and perhaps even some insights on the UK and its ever-changing relationship with Europe. So, ladies and gentlemen, please join me in welcoming Governor Poloz.
Well, thank you very much, Bill, for that very warm welcome. It's always good to be here. Et bonjour tout le monde. C'est un privilège d'être parmi vous aujourd'hui. Un gros merci d'être venu. It's great to be back. I usually don't need much persuading to come and visit people over here in London. And to see so many friends in the audience, I want to thank you very much for being here. So making sense of financial markets. Well, that's supposed to be easy. Stock prices and bond yields and exchange rates are all expected to behave in line with economic fundamentals. But we know the reality is much more complicated than that. Sure, financial markets react to new information. In fact, they usually overreact to new information. And today's overreaction becomes tomorrow's retracement, and so on. And it can be very difficult to reconcile high-frequency financial market action with slower-moving economic fundamentals. Often this process of reconciliation is just a matter of time, since economic data arrive with a lag, while financial markets live in the moment. But therein lies the essential problem. Our view of today's economic fundamentals is actually a forecast, because the data haven't arrived yet. And if financial markets appear to diverge from these forecasted fundamentals, they may be telling us that our forecast is wrong. The fact that financial market prices are formed with the discipline that comes from putting real money on the line means that central bankers ignore them at their peril. Now, to illustrate the difficulty, consider some of the market action we've seen just this year, 2018. Now, yield curves were on a flattening trend all through the first half of the year, raising questions about whether they were pointing to slower economic growth ahead. But at the same time, stock markets were on a steady march upward, which we'd normally associate with a positive economic outlook. Well, this fall, of course, we've seen exactly the reverse: higher yields and widespread stock market declines. And while it may not always be possible to make sense of all of this, I think the effort itself is generally worthwhile. So today, I want to touch on some of the main points of our latest outlook and offer some reconciliation of recent financial market action with that view. Now, of course, there are always risks in trying to interpret what financial markets are saying. They're not monolithic. Their prices represent the average of a diverse distribution of views. Moreover, markets evolve over time. But still, we glean what we can from markets and use the information to cross-validate the signs we see in the economy. So let's discuss the economic outlook briefly. Now, the big picture is that the world has made considerable progress in shaking off the effects of the 2007-08 financial crisis. Now, some countries have made more progress than others, but taken as a whole, the world economy is operating close to potential, and monetary policy has begun the process of normalization. In our latest monetary policy report, we noted that the global expansion, which previously had been quite synchronous across regions, has become less so recently. In fact, the US economy is now setting the pace among advanced economies, mainly due to the additional fiscal stimulus that's been applied. Now, we forecast that global growth will moderate from about 3.75% this year to 3.5% next year, with the US strength expected to ease back by around 2020. Of course, various trade actions and the threat of more have already begun to affect the global economy. The escalation of tariffs between the US and China is a particular concern, weakening investment in the overall growth outlook and putting downward pressure on various commodity prices. A key implication of the divergence of growth between the US and the rest of the world is an appreciating US dollar. And this, of course, has led to strains for certain emerging economies, which we expect to continue. Thus far, however, we've seen few signs of the strains becoming generalized across all emerging markets. As for Canada, our forecast is a positive one. We project the economy will continue to operate close to its capacity limits, with annual growth of around 2% over the next couple of years, and the successful conclusion of North American trade negotiations reduces a key source of uncertainty for the Canadian economy. Meanwhile, we project that inflation will continue to move back down toward the 2% midpoint of our target range after having peaked this past summer. So let's look at what fixed income markets are saying about all this. Now, these are the markets most directly relevant to central banks because bond yields can tell us what investors think about the prospects for both growth and inflation. And in particular, the slope of the yield curve is often seen as a reliable predictor of economic growth. Specifically, when the curve inverts, when short-term bond yields move higher than long-term yields, this is often seen as a sign that a recession is imminent. Of course, no indicator is ever perfect. And to adapt the old quip, the yield curve has inverted before 10 of the last 6 Canadian recessions. But it's important to recognize that a number of factors have held down long-term yields in recent years. And this means that short-term yields don't have to rise as far as in the past to flatten or invert the yield curve. So one of these factors is that the neutral interest rate, or R star as it's affectionately called, has been drifting downward for the past 15 years, contributing to a long-term trend toward lower bond yields. A second factor is that years of successful inflation targeting by central banks have reduced inflation risk steadily. And a third factor has been the buying of bonds by central banks as part of efforts to mitigate the effects of the global financial crisis. So in light of these 3 factors, it seems that the more important signal coming from the bond market is not a flattening of the yield curve, but rather the reversal in a long-standing downward trend in long-term yields. Indeed, since the start of the year, the US 5-year yield has risen by more than 3/4 of a percentage point to over 3%. The 10-year has climbed by a similar amount to about 3.2%. This trend reversal is consistent with the view that a decade of massive monetary policy intervention is finally taking the risk of deflation off the table. Higher bond yields may reflect that the market is becoming two-sided again, as central banks shift interest rate risk back out into the marketplace. In effect, investors can no longer expect yields to be suppressed by extraordinary monetary policies. So within this big picture theme, some important sub-themes are also emerging. One is a worrying tendency among some emerging markets to encroach on the independence of their central banks. Another is the consequences for the corporate bond market. Corporate yields and spreads have for some time been compressed by the post-crisis provision of central bank liquidity, and the trend shift is leading to modestly wider spreads now, as we would expect. Importantly, though, these effects are not uniform across the market. Debt issued by companies most exposed to international trade actions is underperforming other sectors. Specifically, since the start of this year, the spread on debt issued by basic materials and industrial companies has widened 2 to 3 times as much as that on the debt of technology companies. Now, these differences in spreads can be seen globally, and they tell us that investors see growing risks for these firms in light of international trade actions already taken or in prospect. Now, I mentioned that most countries are not as far advanced in post-crisis recovery as the US. However, because bond markets are so globalized, movements in US yields will be reflected in bond markets elsewhere, particularly in countries where central bank bond purchases are not distorting yields. Now, Canada is a case in point. So traditionally, Canadian 5-year yields will import around 2/3 of any movement in US 5-year yields. So this can affect Canadian mortgage rates even with an unchanged stance of Canadian monetary policy. So time now to turn to stock markets. So recent action has some commentators questioning whether many economic forecasts, including our own, are too rosy. As I mentioned at the beginning, such a divergence between the economic outlook and market action needs to be taken seriously. Part of the reconciliation must come from taking a longer-term perspective on equity market performance. True, the S&P 500 has fallen about 7% from its highest level earlier this year. But even with that decline, the index is still about 35% above where it was 3 years ago. Now, several factors drove this performance over the past 3 years. Now, part of it reflected the strong outlook for the US economy and, by extension, company earnings. Part of it, of course, was due to a small number of tech companies, the so-called FANGs, as investors saw the potential for tremendous earnings growth. Now, even though the total assets of the FANG companies equal about 1% of US economic output, their total market cap is almost 10% of the US equity market. And over the past 3 years, the increases in these companies' stock prices were responsible for 17% of the rise in the S&P 500, after accounting for reinvested dividends. But as we saw with the bond market, the era of extraordinary central bank liquidity helped make stock markets more one-sided, naturally suppressing their volatility. Investors could borrow money very cheaply and take leveraged positions in stocks, and now this liquidity is becoming more expensive. So it's only natural to expect more volatility in stock prices as this support is removed. But there's a more fundamental point to make if, as I suggested, the long-term downward trend in bond yields is over. If investors are coming around to the view that expected earnings, as good as they are, need to be discounted by higher interest rates, well, it naturally lowers the price that they're willing to pay for a given stock. Qualitatively, then, it's logical to expect stock prices to retrace some of their earlier increases and to exhibit a more normal level of volatility. The present situation is made even more complex, of course, by the overlay of international trade actions. When we break down recent stock performance by sector, we see a message very similar to the one coming from corporate bonds. The 2% rise in the S&P 500 for this year to date masks some very divergent performances. The companies most exposed to international trade actions have clearly done the worst. Materials companies are down 12% on the year, industrials 7%. Technology companies, in contrast, have risen 8% over the same period. Now, this same basic pattern holds in Canadian stock markets. The main Canadian stock index has declined by 7% this year because the TSX is so heavily weighted with companies that rely on trade. It's evident, therefore, that rising interest rates can explain only part of what we've observed in stock markets. Trade actions are playing a central role. Now, concerns about the impact of ongoing international trade actions by the US and China's retaliation can also be seen in commodity markets. One common interpretation of commodity markets is that rising prices signal future global economic strength. And of course, a slump along the lines of what we are seeing in many commodity markets signals weakness in demand. But a nuanced look at certain markets gives a more focused interpretation. Of course, oil is the global economy's most important commodity and Canada's largest export. However, movements in the oil market tend to reflect more the impact of unexpected changes in supply or demand than shifts in global economic trends. And in the case of Western Canadian Select crude, or WCS, a shortage of pipeline capacity has been weighing on prices. The WCS discount has been especially large of late due to maintenance shutdowns of some key U.S. refineries, which will be temporary. Although most of Canada's exports move by pipeline and see relatively modest price discounts, the newest barrels are discounted the most, and this, of course, is suppressing capacity investment in that sector. But looking beyond oil, we've seen particular weakness in base metals. A generic index of base metal prices has fallen 13% this year. This reflects in part concern about the prospects for China's growth amid ongoing trade disputes. We're also seeing investors taking fewer speculative positions on copper, a commodity closely associated with prospects for Chinese growth. Another contributor to the slump in commodity prices is the fact that they are generally priced in U.S. dollars. So a period of U.S. dollar strength relative to other currencies can lead to lower prices for these commodities, all else being equal. Which, of course, brings me to currency markets, which can give another perspective on prospects for economic growth. Many factors affect exchange rates on any given day. Still, at the root, exchange rates signal expectations for the relative strength of economies and differences in interest rates. So it's not a surprise that the U.S. dollar has outperformed virtually every major currency since the start of this year. This reflects both the prospects for continued U.S. growth and a policy rate increases by the Federal Reserve. The prospect for higher U.S. interest rates is slowing or reversing capital flows to emerging markets. In previous years, this might have raised fears of capital flight, leading to sharp increases in interest rates and significant currency weakness across many emerging markets. So far, at least, the message from currency markets is somewhat more encouraging. Virtually all emerging markets have seen their currency decline against the U.S. dollar, as you would expect. But while several emerging market currencies have shown significant weakness this year, extreme movements have been confined to two, the Argentine peso and the Turkish lira. And in fact, the weakness in the currencies of these two countries may well reflect a risk that I mentioned earlier. Among other risks, of course, that the independence of those central banks has been put into serious doubt. It can be perilous for an economy if investors come to believe that the outlook for inflation is coming under political influence. And by the way, this highlights one of the best attributes of Canada's monetary policy framework. Every 5 years, after extensive research and consultation, the government agrees in writing on the bank's inflation target and gives us the operational independence to pursue that goal. And finally, to the money markets. Expectations for Canadian short-term interest rates are best captured in the overnight index swap market, or OIS. Participants in the OIS market can use the swaps to hedge exposure to future Bank of Canada policy rate changes or to speculate on them. So we watch this market pretty closely because it provides the average forecast of market participants for the path of our policy rate. When the market shifts with some event or the release of economic data, this tells us how participants think our monetary policy will react. And as such, the OIS market is crucial for telling us when there is a disconnect between expectations in the market for the economy and interest rates and our own expectations. This is a key reason why we're generally reluctant to fine-tune market expectations about our interest rate decisions through our communications. If we tried to guide market views so they were always aligned with our own, we would lose the cross-validation that financial markets provide. Well, it's time for me to conclude. Lorsqu'on observe les marchés financiers dans leur ensemble, on constate que les messages qu'ils envoient semblent cadrer généralement avec nos perspectives économiques et avec notre compréhension des principaux risques qui pèsent sur ces perspectives. When you take a broad look at financial markets, the messages they are sending appear to be generally consistent with our economic outlook and our understanding of the main risks to that outlook. After a decade of extraordinary effort by central banks to flood markets with liquidity, the global economy has reached the stage where stimulus can be steadily withdrawn. Investors are are now confronting two-sided risks to the inflation outlook, as central banks are shifting those risks back out into the marketplace, and the long-standing trend toward lower bond yields seems to be over. This, in turn, is producing a recalibration in equity markets, both overall and in the details, and creating a more normal level of market volatility. The U.S. economy is leading the way, and this is strengthening the U.S. dollar. Now, these characteristics don't point to a gloomy economic outlook by any means. Rather, they are welcome symptoms of normalization. On top of this, market action shows considerable evidence of investors' preoccupation with the downside risks associated with international trade actions, both actual and threatened. Now, this preoccupation is understandable, but we must not lose sight of the fact that trade risks are two-sided. Yes, trade disputes may escalate with obvious negative consequences, but it is also possible that resolutions will be found, in which case the world economy will enjoy a new source of lift. We've seen exactly this dynamic play out in Canada, as fears that NAFTA would be torn up have been replaced with relief after agreement on the USMCA. In general, it's not appropriate for a central bank to formulate policy based on only one side of a risk distribution. Rather, the Bank of Canada must attempt to weigh both the upside and the downside risks and take a middle risk-balanced path. Given our outlook for growth and inflation, the bank's policy rate will need to rise to a neutral stance to achieve our inflation target. In determining the appropriate pace of interest rate increases, we will continue to monitor the economy's adjustment to higher interest rates given the elevated level of household debt. And we will pay close attention to new developments on the international trade front. Merci, and thank you very much.
So I think we have a few minutes for some questions. We have some microphones in the audience, so if you just raise your hand and give us a chance to deliver the microphone, and then the governor will kindly answer some questions.
Of course. Yep.
So there's one right here in the front.
There's one right over here in the middle.
Okay, here we go.
Oh, over there. Go. Yes, Ken?
You mentioned the flat yield curve, you mentioned the direction of long-term interest rates. What about break-evens? To what extent do you look at break-evens in terms of economics?
Yeah, we look at them all the time. I mean, I could have stood here for all afternoon probably, given what we do. But we watch them very closely. I'm not sure that they aren't the core thing that we look at. I mean, it's not the thing that gets me up in the morning. But they're a good ready check on what's going on. Absolutely right.
Okay.
I want to congratulate you, first of all, on doing a great job in your communication. Along those lines, I was wondering if you could shed some light on your mentality heading into the December meeting, that being a non-NPR meeting. You're obviously very data dependent. While you've certainly made it clear that every meeting is live, does your obvious data dependency restrict you in somewhat in hiking at non-NPR meetings with quite a bit priced into the NPR meetings for next year?
No, I mean, this is, of course, why on our last decision 10 days ago, we switched from the word gradual, because gradual had become a code word in the markets. It was clear that the markets believed we would raise interest rates at every second meeting when there was a monetary policy report, and we would do nothing in all the other meetings. And so if that becomes code for that, that means like we have people not actually reading the data, they're just confirming their own bias. And so we deliberated long and hard about how should we change that, and basically we changed it so that we didn't give a single word to describe it. Instead, we give a lot more information about, what it is will feed into our decision when it's time to move rates. And that means it could be faster or slower than that original expectation. It means that every meeting is in play depending on what the data have been showing us. So, you know which direction things go. If the data are surprisingly good, then, we're going to be leaning that way because it means that our story is progressing faster than we thought. If the data give us a bit of a pause, then, of course, it'll mean that the data are progressing a little less quickly than we had built in. So it's not that complicated, and there's no new codes there. It's just to explain it more clearly and put some emphasis on the fact that there is a destination in behind of all that. That destination is neutral. Of course, it's not a precise destination. It's more like a neighborhood. Back here? Or where are we?
Thanks.
Okay.
Thanks, Governor. Going back to your first hike all the way to now, it seems like household debt seems to be a very important factor in terms of the pace of hikes and
right.
where you end up at.
Yep.
Could you shed a bit of light in terms of the metrics that you look at on a frequent basis that would inform your opinion on how households are responding to the increase in rates, please?
Right. So this is a really key issue for us because, of course, in these past 10 years, well, we've all been working hard to get the economy back home. We've done so through mostly through low interest rates, and that's meant expanding household debt. And so as it happens, then today, in our models are calibrated so that the effect of an interest rate movement on the economy is about 50% more strong than it was in previous versions of the model. So that gives you some idea how much more sensitive the economy is in a general macro sense. But more to the point, what we do is we actually have data on every segment of that indebtedness. So of course, there's lots of people with no debt at all. It's close to like 40% of Canadians have no debt at all. And then the others that have debt, they range from very little bit of debt to an extraordinarily high level of debt, above 450% of their income. And this, of course, is all to buy a house. And we have those slices, and we know within those slices whether they took a 5-year mortgage or a 3-year mortgage or a floating rate mortgage. So we have that fine of a distinction. And so then when we are contemplating an interest rate move, we're able to simulate that through that entire detailed slice of Canadian society so that we can get a sense of how much will other spending be constrained by a higher interest rate. And then, of course, the next thing we monitor is how do retail sales react to that higher level of interest rates to validate that. So we said a year ago that we'd be monitoring this closely. So over the course of this past year, as we said in the most recent monetary policy report, there's a box there which explains how much detail we went to in this, and basically trying to disentangle the changes to mortgage lending rules from the changes in interest rates, because both things were happening at the same time. And so far, so good. The model is predicting quite well the effects on spending. So to date, at least, the model appears to be doing its job, and we'll continue to monitor it closely as we go forward.
Thank you very much for a robust and optimistic speech. When I look back at my notes here, I'm realizing that you must be looking at the world differently than I'm looking at it right now. What I'm seeing is a Chinese economy which is slow, a US economy which accelerated and now is sort of leveling off, and a European economy which parts of that are actually probably in recession. And some of the strong parts are suffering. Your host country today released a PMI data at 52.2, consistent growth from 0.2%. So we're no longer growing by potential here. So putting that all together, it's a world which is looking quite a lot worse than 2 or 3 months ago. And yet, in your speech, you were very clear that this is quite good outlook. Could you just comment on these more negative ones? That's a big question. Then there's the smaller one, which has to do with
the next question.
The smaller one has to do with one of the prior questionnaires said you have been very good in communication. I would endorse that. And last year was, I think, a textbook example on how you deliver the rate hiking cycle without holding our hands too much, right? And we learned a few things. One thing we learned that GDP is important, right? And you did back-to-back hikes. When you look at the data now in Canada, what is particularly important to you? Is it GDP? Is it wages? What is it?
Well, everything's important, but of course GDP only comes 4 times a year, and it's the most complete picture we get of the economy, so it always has heavier importance. It tells us a lot more. So it's going to tell us about our underlying narratives about investment, capital stock building, capacity enhancement. It's going to give us the better measures of wages, which of course we don't put a lot of weight on LFS wages from last week because they're incredibly volatile. So we've proffered you up a new wage measure, which hasn't moved much over the past year, and so hasn't told us anything, except our surveys of companies suggest they're getting ready to pay higher wages next year. So that's an important insight because all those wage measures are backward-looking, okay? So that's all I'll say about those things. But in terms of your view of the economy, first of all, I don't think we're actually particularly optimistic. Our numbers, if you compare numbers as opposed to just fussing about one word or another, our numbers are very much in line with IMF numbers, OECD numbers, and our Canadian consensus numbers, so consensus economics. So I'm not seeing any outrageous departure there. So the question is, are we aware that China's showing some signs of a moderation? Absolutely. We have a moderation in China in our forecast. We have moderation in the world from 3.75% to 3.5%, which is not trivial at all. I mean, if it went all the way to 2%, that would be a global recession. So a 1/4 point or 1/2 point move in the global headline number is a pretty important deal. The U.S. is moderating in our forecast quite substantially. In fact, it's already peaked. So we take all those things as given, and yet we don't interpret one or two data points as telling us, oh my God, we're falling off a cliff. Well, here it is, okay? Because there are too many other factors that one could point to that suggest the thing is solid and robust. And so, yeah, as I said in my talk, it's possible for you to construct the alternative scenario, and I suppose to write your book in a way that takes advantage of that guess. And that's a privilege that you own out in the marketplace. But as a central banker, we can't do that. We can't go around and say, we think this is going to happen or that's going to happen, therefore. Instead, what we have to do is admit that both of those things are possible. And we have to try and find a risk-managed way to hedge both sides of that. And so if let's say, there was a resolution of U.S.-China trade tensions, I call them tensions, it's sort of a polite word when we're using live ammo, right? It's not just tensions, we're actually throwing pretty big tariffs around. If that all gets resolved, that will be a massive injection of goodwill and positive animal spirits, not just in China, but in the United States and elsewhere. And if you think the U.S. is just riding this, it's happening because of the fiscal shock. Underneath, the U.S. economy is feeling the effects of those trade actions just as much as other economies are. And the stock market is telling you exactly that. So I don't know. You're entitled. That's what makes a market.
Right. I think just in the interest of time, the governor has other obligations later on, but maybe we'll cut it off there.
Okay, if we're going to cut it off there, then we're done.
Thank you very much.
Thank you.